What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. We're going to continue on this week going over some of our top options for 2024, which was featured over on a post on Stocktrades.ca. We spoke on 12 stocks on that list. I believe at the time, 8 out of those 12 are outperforming the S&P and 10 out of 12 are outperforming the TSX. Obviously, this means nothing over the long term, but I'm just trying to tell you that, this list has performed very well in 2024, and you could have gotten it absolutely free at the start of the year if you were on the No BS newsletter, which you have to head down below, subscribe to. It is the best newsletter in the country. 25,000 subscribers getting it every single Sunday or Monday, depending on the week, and you won't want to miss it. So in this week's video, I'm going to be going over a very popular option that has absolutely crushed the markets this year, especially considering its blue chip nature, and especially considering many investors did not like these stocks in 2023, primarily because they didn't really do all that well in 2022 and 2023. And one of the main reasons for this was escalating provisions for credit losses. And I'd just like to highlight, going over this stock this week, which, by the way, the stock is Royal Bank of Canada, how chasing returns is necessarily not that good of a strategy. Past returns of a particular stock have absolutely no bearing on future returns, and I would very strongly caution investors when they're looking to buy, whether it be a particular ETF, whether it be a particular stock, the returns that equity or ETF has provided in the past have absolutely nothing to do with the returns it will produce moving forward. Many investors hated bank stocks in 2023, which looks to be, at least over the last year, 18 months, the absolute best opportunity to buy them. I mean, even a company like Royal Bank is up over 50% over the last year. This is the largest company in the country. This is not a, small cap option here. This is the blue chip, most notable brand on the Toronto Stock Exchange that's, returned 50% over the last year and has been one of the best performing financial institutions in Canada. But let's dive right into why I believe it is still a strong opportunity, despite valuations remaining relatively high, and why it's one of my core holdings inside of my portfolio as well. So as always, everybody, head down below, like the video, smash the subscribe button to stay in touch with more videos we produce. I'm going to be coming on the YouTube a lot more often now because there's been such a strong reception to these videos I'm posting. You can view the one we did last week on Dollarama and Canadian Natural. It got over 4,000 views in the first week of publishing it, and considering how small our channel is, that's just crazy. So it's a video you're not going to want to miss. So Royal Bank of Canada, why I love the stock. So this is a stock I own. It has exposure to 40 different countries. It is the most geographically diverse bank in the country. And what a lot of investors might kind of misinterpret about Royal Bank because of this wide geographical exposure is that it doesn't have that much exposure to Canada, when in fact it has the largest exposure to Canada out of all the major banks. This is primarily just due to a overall, assets under management basis. It is so huge. It has exposure to these 40 different countries, plus the largest exposure to the Canadian economy, which has been one of the main reasons it's absolutely killing it right now, and I'll get to that in a bit. So one of the best underwriting teams of all major institutions. I mean, when we look to the reduction, the stabilization in provisions for credit losses, it's got one of the healthiest loan books out of all the major banks, which is why investors are willing to pay a very premium price to book multiple on this bank. It's trading at some relatively high valuations, which again, I'll get to in a bit. As I mentioned, one of the strongest brands in the country. I mean, I personally would not bank with the Royal Bank of Canada. I have banked with the Royal Bank of Canada. I found it to be a very frustrating experience, but I also try to not let, anecdotal situations in my case dictate my investments. A ton of people bank with this institution. A ton of people like banking with this institution. For some reason, their RBC direct investing platform, despite generating, charging the highest levels of commissions out of pretty much any brokerage in the country. They still have a huge client base, very popular. It's one of the strongest brands. If you're looking for a safe, reliable bank, if you're worried about, like, say, for example, I bank with Equitable Bank, if you're not comfortable banking with an online institution, a ton of people head to, what they view as the largest name, the largest brand, and that would be Royal. So despite tough challenges, it continues to grow earnings in 2024. And a lot of banks are realizing right now how difficult this truly is. And Royal Bank, I believe Royal Bank is growing, CIBC is growing, and National Bank is growing, whereas BMO, TD, Bank of Nova Scotia, I believe Bank of Nova Scotia is relatively flat, but a lot of these banks are reporting either flat or declining earnings because the economic environment is so tough, especially in the United States, which is why you're seeing a bank like Royal, like CIBC, like National, they're outperforming because of the Canadian economy. And as I mentioned, has navigated the economic downturn wonderfully. And if you want, just written thoughts on my thoughts on Royal Bank, I will link to the post above to go there and read, this entire post. But digging into the company's most recent earnings, we're going to tell why it has performed so well. So we're seeing revenue in its most recent quarter, $14.6 billion. This is a 13% year-over-year increase. Now, one of the things you're going to see with Royal Bank in its quarterly results over the last while is the bank is integrating HSBC. They made a big acquisition of HSBC. So you're going to see a lot of adjusted results that kind of exclude this. So we can see revenue is up 13% year over year. 728 million of that 14.6 billion have come from HSBC. So you're looking at around half of their growth is via acquisition, which is definitely why we want to adjust that out and factor that in. So as we can see, net income is up 16% year over year. Actually, we'll go to adjusted net income here, is up 18% year over year. And if we exclude HSBC, it's up around 11% year over year. Now, a lot of people might, kind of not like this 7% decrease, but I mean, this company is growing 11% year over year in one of the harshest economies in terms of, provisions for credit loss, just the overall uncertainty moving forward in the Canadian economy. It's still growing earnings at a double-digit pace, whereas we look to a bank like BMO, their earnings are declining at a double-digit pace. A lot of that has to do with, BMO's exposure south of the border when it comes to commercial real estate, things like that. It's causing a ton of impaired loans. So again, when we look to a adjusted earnings basis, they're up 15% year over year. I would imagine we would adjust that downwards in terms of HSBC again. But when we go to the bank's Canadian segment earnings, so we can see here 22% year over year growth. And again, HSBC is factoring in about 10% of that growth, or they make up around 10% of revenue. 22% year over year growth. When we have, HSBC impact is around 653 million, so just a little over 10%, but we're still looking at double digit growth. We're looking at very strong growth in the business banking segment, but personal banking, no slouch either. We can look at, provisions for credit losses. This is one of the most important things. And this is also one of the main reasons why Royal Bank is performing, outperforming other institutions right now, is we're looking at that provision for credit loss, that quarter over quarter decline in Canadian provisions for credit losses. Now, this is not a recovery of provisions for credit losses. A lot of people confuse this. This is simply on a quarter over quarter basis, it's reported a $145 million reduction in provisions. So this is kind of a sign of provision stabilization, where we're looking at, other institutions like TD, BMO, Bank of Nova Scotia. They're reporting, not necessarily Bank of Nova Scotia, but definitely Bank of Montreal. They're reporting a huge increase in provisions for credit losses. And what this does is it causes a lot of institutional investors, retail investors to worry about where the provisions for credit losses are going to stabilize. When we come to a bank that is either reporting a decline or at least some sort of stabilizing provisions, institutional investors and retail investors are a little more comfortable with, where the bank's earnings are going to be in the future, because, they don't expect these large scale spikes in provisions, which ultimately impact earnings. So for this reason, the decline, and Royal Bank is sitting there with CIBC as some of the banks that are reporting declines in provisions. It's causing investors to pay a higher earnings multiple, and also for earnings to be increasing a little bit more, which is causing, the crazy price increases we've seen with Royal Bank over the last year. And when we look to overall volumes, we can see, when we exclude HSBC, we're seeing gross loans and acceptances are up by 6%. We're seeing residential mortgages up by 6%. Other personal loan loans, 8% growth. We're looking at deposits, 8%, business deposits up by 12%. So this company's brand, this company's reputation, the company's, strong underwriting, stabilization, and provisions is one of the main reasons why it had an outstanding Q3, one of the best out of any Canadian banks, and is one of the reasons why investors are willing to pay such a high earnings multiple and a high book multiple for this company right now, myself included. Now, whether or not I believe the strength in the Canadian economy moving forward will continue, that is a entirely different question. I mean, this increase in mortgages, increase in personal loans, increase in business loans, some could argue that it's not really all that healthy, and this is more of increased loan activity for people to survive rather than, loan activity in relation to economic growth. Because, I mean, let's face it, Canada's economy is not growing all that well right now. However, we are in a situation where we are declining. Interest rates are declining at a faster pace than the Federal Reserve. And as a result, these Canadian banks are benefiting from increased loan activity in Canada relative to the United States. And then when we think of that on that basis, we see, banks like Bank of Montreal, Toronto Dominion Bank, which have a lot of exposure south of the border, and even Bank of Nova Scotia, which has a lot of international exposure. They're not seeing the pickup in loan activity and deposit activity that these Canadian-based banks are seeing. So for that reason, they're really, really going strong right now. Now, whether that continues remains to be seen. We're kind of probably on the cusp right now of, that soft landing versus, recession type situation, whether or not policymakers can navigate around it. But the one thing that is for certain is it's looking like the Bank of Canada, although many pundits say that they still waited a bit too long to drop rates, it was definitely looking like it's been the right decision thus far to decrease rates before the Federal Reserve did. And I am betting in the October meeting, obviously this is never a guarantee, I'm betting we're going to see a 50 basis point cut as well, which should be beneficial for Royal Bank. So again, if we go to total returns, we can see, Royal Bank is returning 50% over the last year. Blue chip Canadian equity, largest company in the country, 50% returns over the last year. When we look to the S&P 500, we're looking at 34%, which just kind of highlights, how well the S&P 500 has done over the last while. There was a lot of Canadians who really, they wanted to get out of Canadian equities and into US equities. And I mean, in 2023, that might have proven to be one of the better times to buy Canadian banking institutions when they were the least popular imaginable. I'd never seen any more bearish sentiment when it comes to Canadian banks, and it proved to be the best time to buy them. So when we look to the company on a dividend basis, it has one of the most reliable dividends out of all the major banks, and I would expect it to be able to grow the dividend at the fastest pace out of all Canadian banks. So we're looking at a mid 3.4% yield, and when we look to in terms of payout ratios, we're looking at 35% for Royal Bank. This would be GAAP payout ratios, IFRS payout ratios. So they are not adjusted out for specific things. So for example, if you adjust Toronto Dominion Bank's payout ratio out for the anti-money laundering issues, it does get a little bit better. It's not actually this high, but on a reported earnings basis, it's at 35%. Whereas you look to companies like Toronto Dominion Bank, like Bank of Montreal, like Bank of Nova Scotia, payout ratios are creeping very high. I would feel these as being very, very high for financial institutions. Even though these are one-time costs for Toronto Dominion, this is likely going to impact their dividend growth moving forward. Same with Bank of Nova Scotia. This payout ratio is way too high to kind of maintain any sort of double-digit or high single-digit dividend growth moving forward. Whereas if you look at Royal Bank, Canadian Imperial Bank of Commerce, and National Bank, they are in a position where they should be able to grow the dividend at a high single-digit pace. They should be able to return to pre-pandemic dividend growth rates, and Royal Bank is in the best position in terms of dividend growth moving forward. Now, the final thing I'm going to talk about is valuation. Now, a lot of people might not want to buy Royal Bank right now because they are trading at a premium valuation, and there is no doubt that they are. When we look to price to book value, we're looking at, around 2 times book. This company typically trades at 1.83x book, so it's trading at, a double-digit premium in that regard. And when we look to price to earnings, we're looking at 14.6x earnings, whereas historical averages are around 12.2. So this company is trading at a big premium to historical earnings, which is pretty much the only time you'll catch me ever using historical price to earnings ratios is to compare it to a historical average. So in this regard, Royal Bank is expensive. I mean, when we look to the PE ratios of the other banks here, you'll see Bank of Nova Scotia 12.5x, Bank of Montreal 14.1, Canadian Imperial Bank of Commerce 11.8 and TD Bank 20. TD Bank, again, that has to do with the anti-money laundering. It's impacting their earnings. So obviously they're going to look really expensive, but they're really not that pricey. They're trading at 20x earnings, but they really aren't if you just adjust those one-time costs. So for this reason, a lot of people are hesitant to buy Royal Bank, but it's important to understand that it does have some of the highest expected growth rates out of all the major banks as well. We're looking at, 2024 expected earnings to come in at $12. This is high single-digit growth from last year. And when we look moving forward, $12.75 in 2025, $14 in 2026. Again, 2026 earnings are really hard to predict. But to give you an idea of this growth rate relative to the other institutions and why the market might be willing to pay more for Royal Bank right now, when we look to a bank like BMO, we're looking at, $11.82 last year. They're expected to decline down to $10.27. And then we look to 2025, $11.09, which is still below 2023 expected earnings. And they're not expected to eclipse their 2023 earnings per share until 2026. So this growth from RBC, this steady growth, is one of the main reasons why I still do believe it's one of the best institutions in the country and why I'm adding to it on a regular basis. So everybody, I hope you liked the video. I focus more so on one stock in this video. Let me know in the comments below if you want me to go back to two, maybe a little bit quicker analysis on two stocks, or you want me to stick to going more in depth on one, and drop in the comments what stock you want me to look at next. But most importantly, like that video, help us out with the algorithm, get more eyeballs on the video, subscribe to the channel so you don't miss future videos, because I'm going to be putting a lot more out, and we'll talk to you next time.